Japan just quietly dumped billions of dollars in US government debt recently. Its Treasury holdings fell by nearly $67 billion so far this year. At the exact same time, China sold $41 billion of Treasuries too. Both of America's largest foreign creditors sold at almost the same moment. Japan alone sold over $47 billion in Treasuries during March alone. That's the largest monthly Treasury sale from Japan in several years. Japan is still America's single biggest foreign creditor by a wide margin. But the direction just flipped, and that shift genuinely matters right now. 10-year Treasury yields have already started reacting to this exact pressure. This isn't a rumor. This comes directly from official US Treasury data. Subscribe now because this channel breaks down exactly this kind of shift. Drop a comment below and tell us if this surprises you. Stay until the very end, because the mortgage connection comes later. Let's break down exactly what happened here, using real numbers first. According to Treasury Department data, Japan held roughly $1.2 trillion. That made Japan the largest single foreign holder of US debt worldwide. The United Kingdom held close to $900 billion in comparison. China held closer to $690 billion as the third largest holder. For years, Japan and China both reliably bought American debt quarter after quarter. That steady buying helped keep US borrowing costs relatively low for years. In the first quarter of 2026, that pattern broke, and broke sharply. Japanese investors sold roughly $29.6 billion of US debt. That was the largest quarterly reduction from Japan since 2022. It also marked the first quarterly outflow from Japan since late 2024. Before that, Japan had bought US debt in 11 of the last 12 quarters. So this wasn't a random blip. It was a genuine reversal in behavior. The selling didn't stay flat either. It accelerated as the quarter progressed. January started relatively modest, but February and March picked up sharply. By March alone, Japan sold roughly $47.7 billion in treasuries. China sold about $41 billion of treasuries that same month. Several other countries joined in too, including Taiwan, Saudi Arabia, and India. Overall, foreign holders sold about $138 billion in March alone. That's one of the larger monthly foreign sell-offs in recent memory. Meanwhile, a few countries actually increased their holdings during that same stretch. The United Kingdom added about $29.6 billion in March. Germany and a few smaller jurisdictions added smaller amounts as well, but the overall trend from America's two biggest historical buyers turned negative. So why exactly is Japan pulling back from US Treasuries right now? The answer starts inside Japan's own domestic bond market, not in America. For years, the Bank of Japan kept interest rates pinned near zero. That policy forced Japanese investors to look overseas for meaningful returns. US Treasuries offered a safe, reliable yield that Japan simply couldn't match. That's a huge reason Japan built up such a massive Treasury position. But that dynamic has been quietly shifting over the past 2 years. The Bank of Japan ended negative interest rates back in 2024. Since then, it has steadily reduced its own government bond purchases. Monthly bond buying fell from about 5.7 trillion yen in 2024. It dropped to roughly 2.9 trillion yen by early 2026. That's nearly a 50% reduction in the central bank's own bond buying. When a central bank buys fewer bonds, yields on those bonds typically rise. That's exactly what happened inside Japan's own domestic bond market this year. Japan's 10-year government bond yield climbed above 2.6%. That's the highest level recorded since 1997, nearly 3 decades ago. Japan's 30-year bond yield touched 4% for the first time in years. Suddenly, Japanese investors could earn competitive returns without leaving their own country. That removed a lot of the incentive to hold riskier foreign bonds abroad. Specifically, it removed this incentive to hold US Treasuries with currency risk attached. Remember, the yen has been extremely weak against the dollar this year. Holding dollar-denominated treasuries carries real currency risk for Japanese institutions. If the yen eventually strengthens, those dollar returns shrink once converted back. With domestic yields rising, that currency risk simply isn't worth taking anymore. That's the core financial logic driving Japan's shift away from US debt. It's not political, at least not primarily. It's a straightforward yield calculation. Japanese life insurers and pension funds are leading much of this shift. These institutions manage enormous pools of money and chase the best safe returns. When domestic bonds finally offer competitive yields, that money naturally comes home. This is sometimes called the end of Japan's decades-long capital export era. For years, Japan exported capital because domestic rates were essentially at zero. That capital helped fund America's own government borrowing at lower costs. Now that capital has real reasons to stay inside Japan instead. That shift alone would matter, even without China's simultaneous selling. But China selling $41 billion in the same month adds another layer. China's reasons appear somewhat different from Japan's straightforward yield calculation. China has been steadily diversifying away from US dollar assets for years. Its central bank has bought gold aggressively for 20 consecutive months. Reducing Treasury holdings fits into that broader diversification strategy over time. Whether Japan and China are coordinating directly remains genuinely unclear and unconfirmed. What is confirmed is that both sold heavily during the exact same stretch. That timing alone has caught the attention of bond market analysts worldwide. When your two largest foreign creditors sell simultaneously, markets notice quickly. US Treasury yields have already started drifting higher in response to this. The 10-year Treasury yield has hovered above 4.4% recently. That's a meaningfully higher level than markets saw just a couple years ago. Higher Treasury yields don't stay contained to bond trading desks alone. They ripple directly into mortgage rates, auto loans, and corporate borrowing costs. That's the exact mechanism connecting Japan's bond market to your own wallet. Some analysts have projected Japan's continued selling could push yields even higher. One economic research group projected an increase of 20 to 50 basis points. That's over the medium term, driven specifically by Japan's reduced buying. A 50 basis point move in the 10-year yield is genuinely significant. It would ripple through mortgage rates for millions of American homebuyers. This is why bond market analysts are watching Japan's next moves closely. The question now is whether this remains orderly or turns more disruptive. Japan selling $29 billion against a $1 trillion position is manageable on its own. Japan meaningfully reducing that entire $1 trillion position would be a very different story. So far, nothing suggests Japan is abandoning treasuries entirely, just rebalancing. But even a modest, steady rebalancing removes a major source of demand. And removing demand for anything tends to push its price down eventually. For treasuries, a falling price means a rising yield, plain and simple. There's a bigger number connecting all of this to America's own debt, and it's next. There's a bigger number connecting all of this to America's own debt. That number is the US national debt itself, now past $37 trillion. Every single dollar of that debt eventually needs a buyer somewhere. For decades, foreign governments like Japan and China were reliable buyers. When those buyers pull back, the US Treasury has to find replacements. Sometimes that means offering higher yields to attract different types of buyers. Higher yields make treasuries more attractive, but they also cost taxpayers more. Interest payments on US debt already exceed $1 trillion annually. That's more than the entire US defense budget spent in a year. Every basis point increase in yields adds meaningfully to that interest bill. This is exactly why Japan and China's selling matters beyond bond trading desks. It directly affects how much the US government spends just servicing debt. Now layer in the current fiscal situation, because it adds more pressure. The Pentagon has requested significant additional funding tied to the Iran conflict. That request alone reportedly runs into the hundreds of billions of dollars. Combined with existing spending, America's fiscal deficit remains historically large right now. A large deficit means more Treasury bonds need to be issued regularly, more bonds being issued at the same time foreign buyers are selling. That combination creates a genuine supply and demand imbalance in the bond market. More supply, less demand, typically pushes prices down and yields up. This is basic bond market mechanics, not speculation or exaggerated fear. Now, here's where the Federal Reserve's own position becomes relevant again. The Fed has been holding rates steady, caught between inflation and jobs. Inflation remains sticky, running close to 4% in recent readings. At the same time, job growth has slowed dramatically over recent months. That combination limits how aggressively the Fed can respond to rising yields. If the Fed cut rates to ease pressure, inflation could reaccelerate quickly. If the Fed holds firm, yields could keep climbing on reduced foreign demand. This puts the Fed in an increasingly difficult position, layered on top of everything else. If you're finding this breakdown useful, now's a good time to subscribe. It helps this channel keep producing detailed, fact-based analysis like this one. Now, let's look closer at what's happening inside Japan's finance ministry itself. Japan's government has publicly acknowledged its currency situation remains genuinely challenging. Officials have stated they stand ready to take bold steps if needed. That language typically refers to currency intervention, buying yen with dollar reserves. Here's the uncomfortable irony sitting underneath that exact strategy, though. To intervene in currency markets, Japan often needs to sell dollar assets. That includes selling US Treasuries to raise the dollars needed for intervention. So currency defense and Treasury selling are actually deeply connected mechanisms. Japan isn't necessarily selling Treasuries to punish America financially at all. It may simply need the cash to defend its own weakening currency. That's a more mundane explanation, but it's also the more accurate one. Still, mundane or not, the market impact remains exactly the same. Fewer Treasury buyers means higher yields, regardless of the underlying motivation. Now, let's address China's role again because it's genuinely different from Japan's. China doesn't face the same currency intervention pressure Japan currently faces. China's Treasury selling appears tied more to long-term strategic diversification. Its central bank has bought gold for 20 consecutive months running. That's the longest streak of monthly gold purchases in recent record. Reducing dollar-denominated assets while increasing gold fits a consistent pattern. Analysts describe this as part of a broader de-dollarization strategy. That doesn't mean China is abandoning the dollar system entirely. That's an overstatement. China still holds roughly $690 billion in treasuries. That's still an enormous position, even after this year's selling. But the direction of travel matters as much as the current total. Both Japan and China are trending the same way, just for different reasons. That combined trend is what's genuinely catching the attention of bond markets. When your top two foreign creditors both trend towards selling, yields respond. Now, some perspective is genuinely important here before drawing extreme conclusions. Japan's $29.6 billion sale represents about 2.5% of its holdings. That's a meaningful shift, but it's not a wholesale abandonment of treasuries. Japan still holds well over $1 trillion in US government debt. China still holds hundreds of billions of dollars in treasuries as well. Neither country has signaled any intention to fully exit the treasury market. This is a rebalancing story, not a collapse story, and that distinction matters. But even modest rebalancing at this scale ripples through global bond pricing. Because treasury markets are enormous, even small percentage shifts move real money. A 2.5% shift on $1 trillion position is tens of billions. Multiply that across multiple countries, and you get real market moving flows. That's exactly what's been happening across the first half of 2026. Now, let's connect this back to something that affects Americans directly. Mortgage rates in the United States track closely with the 10-year Treasury yield. When that yield rises, mortgage rates typically rise alongside it fairly quickly. That's been a major reason home buying has remained expensive this year. If foreign selling keeps pushing yields higher, mortgage rates could climb further. That directly affects millions of American families trying to buy homes. It also affects anyone looking to refinance an existing mortgage right now. Auto loans and credit card rates follow a similar, though less direct, pattern. Higher borrowing costs across the board tend to slow consumer spending overall. That creates a genuine feedback loop between bond markets and everyday household budgets. This is why bond market analysts pay such close attention to foreign holdings data. It's not abstract finance theory. It flows directly into real household costs. Now, some analysts have raised a more speculative question worth mentioning here. Could Japan's selling ever become disorderly instead of just steady rebalancing? If Japan needed dollars urgently for a much larger currency intervention, it could theoretically sell treasuries faster than markets can comfortably absorb. That scenario would push yields up more sharply than gradual selling would. So far, nothing in the data suggests that disorderly scenario is unfolding. Japan's selling has been described by analysts as measured, not panicked, but it's a risk factor. Serious bond investors are watching closely regardless. The same applies to China, should its diversification strategy ever accelerate suddenly. Right now, both countries appear to be adjusting gradually, not abruptly. That gradual pace is exactly why this hasn't triggered a full market panic. But gradual pressure, sustained over time, still adds up to real consequences. Higher yields, higher borrowing costs, and a more expensive U.S. debt load. All three of those consequences are already visible in current market data. This is the bigger picture connecting Japan, China, and America's own treasury market. Two of the largest foreign creditors are quietly stepping back at once. In the next part, we look at what this means for the months ahead. Stick around, because what happens next could shape your borrowing costs directly. Stick around, because what happens next could shape your borrowing costs directly. Let's start by looking at where Treasury yields could realistically head next. The 10-year yield already sits above 4.4% currently. If foreign selling continues at a similar pace, yields could climb further. One research group projected an increase of 20 to 50 basis points. That projection was tied specifically to Japan's reduced Treasury buying alone. Add China's simultaneous selling, and that pressure could compound even further. A 50 basis point increase might sound small, but it isn't in practice. On a typical 30-year mortgage, that difference adds real monthly cost. For a family buying a median-priced home, that adds up quickly over time. Multiply that across millions of mortgages, and the economic impact becomes significant. This is exactly why the Federal Reserve watches foreign treasury demand closely. The Fed doesn't control foreign buying decisions, but it does react to their effects. If yields rise too sharply, it complicates the Fed's own policy decisions. Rising yields can act like an unofficial tightening, even without Fed action. That's sometimes described as the bond market doing the Fed's job for it. In some ways, that's already been happening throughout the first half of 2026. Now, let's bring the dollar itself back into this picture again. The US dollar index has remained relatively strong for most of this year. That strength partly reflects continued global demand for dollar-based safe assets. But foreign selling of treasuries represents a subtle counterpressure against that strength. If Japan and China continue reducing dollar assets, that dynamic could shift. For now, the dollar remains strong, but the underlying trend deserves attention. Some analysts describe this as a slow structural shift, not a sudden one. Reserve currency status doesn't change overnight. It erodes gradually over many years. The dollar's share of global reserves has already declined over the past 2 decades. It fell from around 70% to under 60% of global reserves. That's still the dominant share by a wide margin over any other currency. But the direction of that trend matters just as much as the current number. Japan and China reducing Treasury holdings fits into that same broader pattern. Now, let's talk about what this means for everyday American investors specifically. If you hold bonds directly, rising yields mean falling prices in the short term. That's simply how bond math works. Prices and yields move opposite directions. If you're holding bonds for the long term, rising yields eventually mean better returns. New bonds issued at higher yields pay more income going forward. That's a genuine silver lining for long-term, patient, fixed-income investors. For stock market investors, rising yields create a different kind of pressure. Higher yields make bonds relatively more attractive compared to riskier stocks. That can pull some money out of equities and into safer bonds instead. This is one reason stock markets often react negatively to sharp yield spikes. For homeowners and buyers, the connection is even more direct and immediate. Mortgage rates have remained elevated for most of this year already. Continued foreign selling makes a swift decline in mortgage rates less likely. That keeps home buying expensive and refinancing less attractive for many families. Now, let's revisit gold again, because it connects directly into this story too. As foreign confidence in treasuries shifts, gold has attracted renewed interest. China's 20 consecutive months of gold buying reflects part of this shift. Central banks broadly have been diversifying reserves beyond just dollar-based assets. Gold delivered its strongest annual performance since 1979 for related reasons. That's not a coincidence. It reflects the same underlying diversification trend. Countries reducing treasury exposure often increase gold exposure as a counterbalance. This pattern connects Japan's bond selling, China's gold buying, and global reserve trends. It's one continuous story about how major economies are managing currency risk. Now, let's address a common misconception worth correcting directly here. This isn't the same as America suddenly losing access to borrowing entirely. The US Treasury market remains the deepest, most liquid bond market on Earth. There will always be buyers somewhere, even if the composition of buyers shifts. Pension funds, insurance companies, and domestic investors can absorb some of this. The Federal Reserve itself can also adjust its own balance sheet if needed. The real story isn't collapse. It's a gradual, meaningful shift in demand. That shift raises costs and adds friction, but it doesn't break the system. Understanding that distinction matters for interpreting headlines about this topic accurately. Sensational framing aside, the actual mechanics here are measured, not catastrophic. But measured doesn't mean irrelevant, especially for anyone with a mortgage or loan. Now, here's what to actually watch in the coming months going forward. Watch upcoming Treasury international capital data released monthly by the US government. That data reveals exactly how much Japan and China are buying or selling. Watch Japan's domestic bond yields too, since they're driving this entire shift. If Japanese yields keep rising, expect continued pressure on Japan's Treasury holdings. Watch the Bank of Japan's policy meetings for signals on future rate moves. Watch China's gold purchases, since they've continued uninterrupted for nearly 2 years. Watch the 10-year Treasury yield itself, since it directly affects mortgage rates. If it climbs meaningfully higher, expect mortgage rates to follow closely behind. None of this requires guessing. The data updates monthly and remains public. Staying informed on these specific releases matters more than reacting to headlines. This is exactly why breaking this down clearly, without hype, matters so much. The goal here isn't predicting a debt crisis or promising a specific outcome. The goal is understanding the actual mechanics connecting Japan, China, and your money. 2 of America's largest foreign creditors have both pulled back this year. That's a real measurable shift backed directly by official Treasury Department data. Whether it continues, accelerates, or reverses remains genuinely uncertain right now. What is clear is that the reasons behind it are structural, not random. Rising Japanese yields, a weak yen, and China's gold-focused diversification all play a role. Layered underneath all of that sits America's own $37 trillion debt. That debt needs buyers every single month, regardless of who steps back. When traditional buyers pull away, yields adjust to attract someone else instead. That adjustment is exactly what's rippling through mortgage rates right now. This combination makes this one of the more important bond market stories this year. Not because of hype, but because of the sheer scale of money involved. $67 billion in reduced Japanese holdings doesn't happen without real cause. $41 billion in Chinese selling in a single month doesn't happen randomly either. 29 consecutive months of central bank gold buying reflects genuine underlying strategy. All of this combines into the situation unfolding across bond markets right now. Keep watching the data, not just the headlines, and you'll stay ahead of most people. If this breakdown helped make sense of a genuinely complicated situation, hit subscribe. It directly supports more detailed, fact-based breakdowns just like this one. Drop a comment with your own take on where Treasury yields head next. Share this with someone who has a mortgage or is planning to buy one. Thanks for watching until the very end of this breakdown. Stay tuned, because this story is still developing and we'll keep tracking it.